Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Evan, I wanted to talk about a couple of things today. Firstly, the RBA minutes yesterday. They're saying economic growth, but it's not translating into wages. So I just wanted to talk about that.
Yeah, look, the minutes are always the colour you don't get from the statement. So that was what I was looking forward to tomorrow. Sorry, what came out yesterday. Around that, it was, as he's pointed out, growth is clearly their key. So they really highlighted that in the statement, and they really fleshed that out in the minutes. So they clearly show you that net exports are doing much better than we expected, the construction growth, the growth around jobs, the growth that they're also seeing in the underlying economy across the board, all leads them to believe that their 3% their 3% target will be reached by 2018. The caveat with that, as you pointed to, was the wage growth. And again, they fleshed that out. So although they see jobs growing at a level they haven't seen basically in the post-GFC world, it's not translating into wage growth. And what they also highlighted, and it's actually quite a big chart that they point out, was if you have a look at the net debt position of households, it's flatlining, and it has been since 2013. So from 1993, which is basically the 0 point, so at 100, it's gone up to about 160 in terms of growth, but it's flatlining and it's not breaking through. And that's their real concern, is that it clearly shows you that wages have not only been flatlining this year, but have been flatlining for the last 4. And that translation into, therefore, what we've talked about a couple of times before, which is the stability survey that came out a couple of weeks back, which showed that almost 60% of the average household income now goes to what they describe as basics, which is your housing, education, health, energy, and food. 60% basic. It's just a bit short of that, but that all gets into that figure. So that's their caveat, is that because wage growth isn't moving, it therefore translates that inflation therefore isn't moving in the direction they wanted either. And that gets down to the idea that, yes, we've got growth, but there's an uneven movement in the economy. And that explains what I'm now calling their dead on the fence position. They are so neutral, it's not funny. They shed their slightly hawkish feathers. They clearly showed and said in the statement and in the minutes we saw yesterday that they are not like their global peers. They are not like the ECB, the BOE, the Fed, etc. They are not interested in following global leads. They are looking at domestic and domestic only. The market took it as dead neutral. Rates therefore are on hold for at least the next 6 months.
Yeah, and we're still not seeing really any growth in consumer confidence. It's still pretty flat to low.
Yeah, despite last week, we snapped out of a 10-month consecutive pessimistic month. Even Westpac themselves told you that confidence survey surprised them to the upside, and it was around jobs growth. People are actually now more, they have more security, is probably the way to put it to you, around the idea that their job will be there in 12 months' time. And the fact that they are seeing job creation is part of the reason why they're more optimistic. It doesn't override the fact that they clearly still believe that housing affordability, housing debt, and interest rates are big headwinds to consumption and big headwinds to consumer confidence. So that all fits back into it perfectly in terms of what happened with the minutes yesterday, is that the RBA is acutely aware that everything's pretty finely poised, and for that reason, they're out of the game.
Now, the other thing I want to talk about is China and stepping back to the quarterly production results coming out from the big miners in iron ore. There's a direct correlation there.
There is a direct correlation, despite the fact that BHP put in their quarterly report that they were slightly lower than they expected quarter on quarter. You're right. Iron ore has been booming for them, and iron ore for the country has been booming. So putting my macro hat back on, if you have a look at net exports, the value of net exports has been down to the reason that commodities are really on the up. And it's not just iron ore, it's copper, it's coal. They've been doing incredibly well for our net exports, and that comes down to the Chinese story. A lot of people will highlight that the Chinese, for the first time in history, imported over 100,000 megatons of iron ore, and it's been basically moving at a 45-degree linear angle. They also now show, and this again probably is the more important thing from an Australian-centric point of view out of China, is that China clearly is moving on an environmental policy around cracking down on basically what is probably uneconomic usage of materials. So steel production is now a very clear target of them. So the higher your ferrous content, as in the higher amount of iron in your ore, the better price you're getting. So for the first time in a long time, for 62, 58 and 55, ferrous contents are diverging
And
quite
that's our
dramatically.
advantage, obviously.
And that's our advantage. So most of our miners, not all of them, but the majority, particularly the bigger end of town, produce ferrous content at 62%. And that's the price that we quote. When you talk about the iron ore price, that's the price you get. So if you see that the spot price was 62 US a ton, that's 62%. So you actually get a haircut of between 15 as much as 25% on that price if you've got the lower content. And that's the other part of this. So again, why this week is so big in China is because not now and not for the next 3 years, but 2020 and beyond, what happens with Xi Jinping's China, which let's call it, that's what it is, will be interesting from that growth. Because again, the more, the better you can be at the content you produce will be, what they're after. They're clearly cracking down on unproductive steel that's making a loss, because that gets back into their financial stability. And that's all part of what's going on at the moment with the Chinese story. So it will impact us. And again, those that are doing the best that they can with the ferrous content they have will be probably the winner.
And there's been quite a lot going on with the Chinese cracking down on these polluting industries, which is having a positive impact for a lot of our miners across different sectors as well.
Yeah, it is. And I'll probably highlight the steel again, but also have a look at coal. The Chinese have their own coal and iron ore markets. They do actually produce themselves. It's incredibly poor, and I think that needs to be probably highlighted, particularly their coal. It's very, very dirty, and it's not as clean as what is produced here, which again explains why our coal miners have been having a bit of a rally this year. It explains why thermal coal, not met coal will always be around, but thermal coal has had a bit of a rebound this year. So look at the Platts price, and they've shown you very clearly that coal's doing okay. Again, the question that is very hard to answer right now with what's going on with the NPC, so the National People's Congress, is how much state input he will turn the country towards, and whether or not it becomes a really domestic-focused country and puts China first. Now, that's always the case anyway, and the reason I say that is that, again, there may be increased tariffs. It may be a way also of stopping outflow of funds, is a way of also cracking down on it. If you're not paying for imports, you can keep your currency in a more regular check, and that's also part of his concern because of the level of debt that they hold. So there is caveats to what I'm talking about, and that's why this week is so important from an Australian-centric point of view, because yes, the 2020 and 2030 decade will be impacted by what brings in at this 19th Congress that's happening right now.
Well, we'll see what happens this week.
Thanks, Tony.
Thanks very much, Evan. Join us again next time for the Economic View.